Okay, so imagine this. You're sitting at your desk, eating lunch, scrolling through your phone, and you get hit with one of those ads for a micro investing app. You know the ones I'm talking about. Invest your spare change. Start with just $5. Build wealth while you sleep. And you think to yourself, yeah, maybe I should do that. I mean, it's better than nothing, right? So you download the app, throw in $100, feel good about yourself for like 3 days, and then completely forget it exists. That's exactly what I did. Except I took it way further than any reasonable person should. My name is Oric, and I spend way too much time thinking about whether these micro investing apps are actually helping people build wealth or just creating the illusion of financial progress. If you're someone who knows they should be investing but feels paralyzed by all the options, or if you've downloaded 3 different investing apps but have no idea which one to actually use, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's what I did. I took $100 and put it into 5 of the most popular micro-investing apps: Acorns, Stash, Robinhood, Public, and Webull. Same amount in each app. Same time period, 90 days, and I'm going to show you the exact results, the fees that ate into my returns, and which app actually makes sense for someone just starting out. But here's the thing, this isn't just about which app made the most money. Because honestly, if that's all you care about, you're asking the wrong question. What matters way more is understanding the psychology these apps use to keep you engaged, the hidden costs that nobody talks about, and whether micro-investing is even the right strategy for you in the first place. Look, I need to be honest with you right up front. A study from the Financial Health Network found that 63% of Americans couldn't cover a $400 emergency expense without borrowing money or selling something. 63%. That means the majority of people watching this video right now are one-car repair away from financial chaos. And yet, these micro-investing apps have convinced millions of people that investing spare change is the solution to their money problems. It's not. Let me be very clear about that. If you don't have an emergency fund, if you're carrying high-interest credit card debt, if you're living paycheck to paycheck, micro-investing is not your priority. I don't care how slick the app interface is or how good it feels to see that little number go up. You're building a sandcastle while your financial foundation is underwater. But if you've got those basics covered, if you've got 3 to 6 months of expenses saved, if you're not drowning in debt, then yeah, let's talk about whether these apps are worth your time. So here's how I set this up. On January 1st, I put exactly $100 into each of these 5 apps. I didn't add any additional money. During the 90 days, I just let it sit and do its thing. I chose the default portfolio recommendations from each app, the ones they suggest for someone in their 30s with moderate risk tolerance, because that's what most people are going to do. Nobody's spending hours customizing their portfolio in a micro-investing app. They're clicking the big green button that says Get Started and moving on with their lives. Now, you might be thinking, Oric, 90 days isn't enough time to judge investment performance. The stock market is volatile. You could have just gotten lucky or unlucky with timing. And you're absolutely right. But here's what most people don't realize. I'm not trying to find the app with the best returns. I'm trying to understand the complete experience of using these apps as a beginner investor. The returns are just one piece of the puzzle. Let me break down what happened with each app, and then I'll tell you which one I'm actually keeping my money in. Acorns was the first one I tried, and it's probably the most well-known micro-investing app out there. They pioneered the whole round up your purchases concept. You buy a coffee for $3.50, and Acorns automatically invests the $0.50 to round it up to $400. Sounds brilliant, right? Effortless investing. Here's the problem. Acorns charges $3 a month for their basic tier. $3 a month might not sound like much, but do the math with me. If you're investing $100 and paying $3 a month, that's $36 a year in fees. That's a 36% annual fee on your initial investment. Let me say that again. 36%. Warren Buffett recommends index funds with expense ratios of 0.04%. Acorns is charging you 900 times more than that in the first year. Now, yes, As your balance grows, that percentage goes down. If you have $1,000 invested, it's 3.6% annually. If you have $10,000, it's 0.36%. But here's the thing. Most people using Acorns don't have $10,000 in their account. The average Acorns user has less than $500 invested according to their own investor presentations. After 90 days, my Acorns account was worth $103 and burned $47. That's a 3.47% gain. Not bad, right? Except I paid $9 in fees over those 3 months. So my actual return after fees was negative $5.53. I lost money. The market went up, and I lost money. This is where it gets really interesting. Acorns knows this. They're not stupid. Their business model isn't based on you keeping $100 in the app forever. It's based on behavioral psychology. They're counting on you setting up automatic investments, linking your debit card for roundups, and slowly building a larger balance over time. The app is designed beautifully. It's engaging. It gives you little notifications celebrating your progress. You just invested $2.50 in your future. It makes you feel good. And look, I'm not saying that's evil. Getting people to invest who otherwise wouldn't is genuinely valuable. But you need to understand what you're paying for, that feeling. Stash is similar to Acorns, but with a slightly different approach. Instead of just roundups, Stash lets you pick individual stocks and ETFs based on themes. Want to invest in clean energy? There's an option for that. Think gaming is the future? They've got you covered. It's investing meets personality quiz, and honestly, it's kind of fun. They also charge $3 a month for the basic plan. My Stash account after 90 days was worth $104.82, which is a 4.82% gain. After fees, I was up $1.82. So I actually made money, unlike with Acorns, but barely. Here's what bothered me about Stash: the illusion of choice. They give you all these different investment options, and it makes you feel like you're being strategic, like you're really taking control of your financial future. But here's the reality. You're still just buying ETFs. You're not outsmarting the market by choosing the American Dream portfolio over the clean and green portfolio. It's financial education theater. Now, Robinhood is where things get different. No monthly fees, no account minimums, commission-free trading. This is the app that democratized investing, or at least that's what their marketing says. My $100 in Robinhood, which I put into a diversified mix of index funds, grew to $105.20 bonds after 90 days, a 5.2% gain, and because there are no fees, that's my actual return. So Robinhood wins, right? Best returns, no fees, case closed. Not so fast. Here's what nobody tells you about commission-free trading. You are not the customer. You're the product. Robinhood makes money through something called payment for order flow. Basically, they sell your trade information to high-frequency trading firms who use that data to make money off tiny price differences. It's legal. It's disclosed in their terms of service that nobody reads, and it's how they afford to charge you zero fees. Does this hurt your returns? For most beginner investors making small trades, probably not in any meaningful way. But it's worth understanding the business model. Nothing is actually free. You're always paying somehow. Public tried to position itself as the ethical alternative to Robinhood. They eliminated payment for order flow and instead make money through optional tips and premium features. I respect that. It's more transparent. My $100 in Public grew to $104.95, a 4.9% return, slightly less than Robinhood, but pretty close. The app also has this social feature where you can see what other people are investing in and follow their trades, which sounds cool until you realize you're taking financial advice from random strangers on the internet. Look, I like the transparency of Public's business model, but the social features worry me. Investing shouldn't be a social media experience. It shouldn't be about following influencers or feeling FOMO because everyone's buying the same stock. That's how you end up making emotional decisions instead of strategic ones. Finally, Webull. This is the app for people who want to feel like day traders without actually knowing what they're doing. Advanced charts, real-time data, extended trading hours, all the bells and whistles. My $100 grew to $105.15. Basically the same as Robinhood. No fees for basic trading. But here's my issue with Webull. It's designed to make you trade more. The interface is complex enough that you feel sophisticated using it, but accessible enough that you think you know what you're doing. And here's what most people don't realize. The more you trade, the worse your returns typically are. A study by Terrence O'Dean at UC Berkeley found that the investors who traded the most earned an annual return of 11.4%, while the market returned 17.9%. The people who traded the least beat the market. Let that sink in. The act of trading, of trying to be smart and active and engaged, actually cost those investors 6.5% per year. Webull's entire design philosophy is built around encouraging frequent trading. More trades mean more payment for order flow revenue for them, worse returns for you, but you feel like you're doing something. So after 90 days, here's what I learned. If we're just looking at raw returns after fees, Robinhood came out on top at 5.2%, followed closely by Webull at 5.15% and Public at 4.95%. Stash made me $1.82 after fees, and Acorns lost me $5.53. But here's the bigger lesson. None of this actually matters for your long-term wealth building. You know what would have beaten all of these apps? Taking that $500 total, putting it directly into a Vanguard or Fidelity account, buying a single index fund like VTI or VTSX, and never thinking about it again. No monthly fees, lower expense ratios, same or better returns, way less complexity. The psychological shift you need to make is this. Investing isn't supposed to be entertaining. It's not supposed to make you feel smart or engaged or like you're gaming the system. It's supposed to be boring. Boring is good. Boring means you're not making emotional decisions. Boring means you're not paying fees for features you don't need. Boring means you're just letting your money grow. These micro-investing apps are solving a real problem, which is that investing feels intimidating to most people. They're lowering the barrier to entry, and that's genuinely valuable. But they're doing it by creating a new problem, which is making investing feel like a game or a social media platform or a personality expression. Now, you might be thinking, okay, Oric, so what should I actually do? Here's my recommendation. If you have less than $1,000 to invest and you genuinely won't invest at all without the hand-holding and gamification of these apps, then use Robinhood or Public. Zero fees means your money is actually working for you. Set up automatic investments, pick a broad market index fund, and then delete the app from your phone so you're not tempted to check it constantly. If you have more than $1,000, open a Vanguard, Fidelity, or Schwab account. The interface isn't as pretty, but you'll pay way less in fees over time, and that will matter enormously over decades. A 1% difference in fees can cost you literally hundreds of thousands of dollars over a 40-year investing career. And if you don't have an emergency fund yet, don't invest anything. I know that's not what you want to hear. I know investing feels sexier than having cash sitting in a savings account. But you cannot build wealth without stability first. You cannot grow a tree without roots. Here's what I want you to do after watching this video. First, figure out if you're actually ready to invest. Do you have high-interest debt? Do you have 3 to 6 months of expenses saved? If the answer to either of those questions is no, your action step is to fix that first. If you are ready to invest, pick one app or platform and commit to it. Not 5. 1. Decision fatigue is real, and having your money scattered across multiple platforms just means you'll never develop a consistent strategy. Set up automatic investments. This is non-negotiable. The single best predictor of investing success is consistency, not timing, not stock picking, not finding the perfect app, just showing up month after month and investing a portion of your income. And finally, stop checking your account every day. I'm serious about this. The more you look at your investments, the more likely you are to make emotional decisions when you see red numbers. Set it up, automate it, and then focus on increasing your income and reducing your expenses. That's where the real wealth building happens. The truth is, These apps aren't going to make you rich. No app will. What makes you wealthy is earning more than you spend, investing the difference consistently, and giving it time to compound. These apps are just tools. Some are better than others. Some charge more than they should, but ultimately, they're all just different vehicles to get you to the same destination. The question isn't which app is best. The question is whether you're actually going to use it, whether you're going to invest consistently, whether you're going to resist the urge to panic sell when the market drops, whether you're going to stay disciplined for years and decades. That's the real battle. Not Acorns versus Robinhood, but you versus your own psychology. And that's a battle these apps can't win for you. You have to do that part yourself. If this video helped you understand these micro-investing apps better, hit that subscribe button. I make videos breaking down personal finance topics that actually matter to real people trying to build wealth. And if you want me to test something else, leave a comment below. I'll probably do it because apparently I have no boundaries when it comes to financial experiments. Now go set up that automatic investment. Your future self will thank you.